The art and science of trading is one course that I've designed keeping all this experience that I've had throughout the years from interacting with both greatly successful guys in the market and those who are still struggling with their money to make that kind of alpha returns. Well, personally, my ride in the stock markets have been fairly mixed. It's not like that from the first day I've been extremely successful, not at all. But I would be honest to say that there are a few things that I've learned. And those learnings I've kept in this art and science of trading. And my intention is to going forward, share these insights about the entire field of trading and how one can make a living out of it. So without much ado, let's get on with it. Disclosures are always a very important thing whenever we talk about financial markets. So this presentation is purely educational in nature, and all symbols and investments trading ideas discussed by me or any of our instructors in any of our webinars are for demonstration purpose only. These are not recommendations to buy and sell into any asset classes. Well, in our webinars, we do show charts and we do use softwares. So please note that hypothetical or simulated performance results have certain inherent limitations and do not represent actual trading. Simulated trading are generally designed with the benefit of hindsight. No presentation is being made herein that any account will or is likely to achieve profits or losses similar to those shown here. This demonstration is not a recommendation to buy or sell financial instruments, but rather guidelines to interpret and use specific indicators and features within the software. This paragraph is quite relevant for this webinar of ours because of the fact that in this webinar I'll be showing you screenshots, I'll be showing you a few of the softwares that we will be using in the course of art and science of trading. We strongly suggest that information and techniques presented should only be used by investors who are aware of the risk inherent in trading. ElonMarkets.com will have no liability for any investment decisions based on the use of information and or techniques shown in this presentation. Right. So the disclosure is taken care of. Let's move ahead. For those who know from from where I'm coming from, my name is Abhijit Paul. I've done my economics BSc from Kolkata University, and I've done my MBA in finance. 2004 to 2014, I was in Mumbai. I worked with few premium broking houses, sell-side broking houses, ICICI Securities. And my last assignment was as the AVP of BRIC Securities, where I was heading the entire institutional technical research desk. So in those 10 years of my experience, I have interacted with many individual traders, individual investors, ultra HNIs, institutions starting from mutual funds, insurance companies, and hedge funds also. That's how I've gathered all this information talking to various people in the financial markets and how they look into the market per se when they trade in and out of the market. I am also a visiting faculty with the National Stock Exchange in their MDP programs. These are conducted across various cities like Calcutta, Ahmedabad, Mumbai. I'm also a faculty with the National Institute of Bank Management, Pune. Quite a few of those business schools, and here and there taking corporates workshops as well. I do tend to come on media, and then over there I share my views about the markets and etc. So that's whom you will be listening to. I again thank you everyone to joining in. The intention with this webinar is to share a little sneak peek, a little trailer of what we are looking into when we start this course, the art and science of trading. The very first batch starts on 21st of Feb this year. So the art and science of trading is designed in mind that we'll be looking into theory. We'll be using a lot of practical, because trading theory, knowing the theory does not finish the whole thing. You need to practice and realize, especially on those trades when you go wrong. Also, I'll be introducing few case studies. Few will be the ones that we are aware of, like doing on the financial markets. But this time I've kept a little surprise where we'll be looking to do a video case study also. Just hang on one sec. Yeah, guys, I'll request everyone to please mute yourself. There's background music. The organizer anyways will mute you. Request you to click on the green mic sign. Yeah, I think that's fine. Thank you, Vivek, for flagging that off. Okay, let me continue. Is that okay now? I think most of our attendees are muted now. I don't hear any background noise, so let's get on with it. So that's exactly how I've broken this entire course of Art and Science of Trading. The theory part will be a critical part where we'll start about, what the course is all about. We have 4 to 5 different aspects of it. The first aspect is it's a perfect blend of theory and practical. Why I've kept this blend is because of the fact that I've seen in my years a lot of trainings in technical analysis or trading. They focus a lot on theory, which is fine. You need to know how to use these tools. But then just knowing does not, suffice. Just if you read a book on how to swim does not make you a great swimmer, right? So when you know and hear us out about the theoretical part of financial markets or trading per se, the practical end goes missing. So in this course, what I've tried to do is, put in some practical usage of what you've learned, make some trades, make some mistakes, maybe make some great trades and actually learn from those trades. Secondly, it's a tailor-made training in the field of technical analysis. We'll be looking to be, try to make a decent trader out of each and every participant of this course. Technical analysis is the subject which helps you to learn about trading price-wise. We have purposely kept the deep value picking methods out of this. The intention is to trade effectively. Technical analysis is a vast subject. There's a lot of stuff that one can read about it and get lost. That's why I've purposely kept this course very to the point, especially the vertical where we talk about indicators, market indicators. This part has zillions of indicators, and one can easily get lost for his entire lifetime just to find out which indicator, the right indicator to use. And honestly, if you ask me, you'll spend years, and I've done it myself also to some extent, but you don't find out the right one. There's no right one. That's the true, holy grail. So what I've done with this course is to keep the entire thing short. Less is more. We'll be talking about those indicators, those part of trading, those part of technical analysis, which is relevant, very important, which is relevant for our point of view of trading into the market. We will not be discussing theory, which will not be implementing. So I've kept the theory precise, to the point, less is more. Third, we're looking to guide you, to hone the right trading psychology. If you honestly ask me, after this 11, 12 years of, spending into the stock market, and I intend to, spend the rest of my life in this field. If you ask me what is one factor which is very important for being successful in the market, I'll definitely say psychology is a very, very important person. At times I used to say probably psychology is 75% important, 25% goes into your techniques and all. Slowly over the years, this percentage has gone up, and if you ask me, I would say probably 90%, 95% is all psychology. So in these Art of Science of Trading, we'll be talking a lot about this part of a personality, how you can develop and have the mindset of a trader. So we'll be learning to balance mind, money, and method. By mind, I'm talking about the psychological part. You have to start thinking like a fund manager. You have to start thinking, behaving, feeling like as if you have a fund in your hand and you are trading the market. Money is obviously very important, capital that you will be risking into the market to make more out of it. Money makes money. And then there's the technique, there's a method. So the Art and Science of Trading is looking to keep a nice blend, a nice mix of these three verticals. Free access to trading software. Yes, as I said, practical experience is very important. So as when we go through the theory, parallelly we'll be using trading softwares. We have a couple of trading software partners with us. Spider Software is one of them. Investor India is one of them. I will be showing you these softwares today later on. And every participant who joins into this art and science of trading will actually have these softwares to use for a limited period of time. For forex markets and all, I will be giving you hands-on training on the most widely used and the really very good one, which is netdania.com. The last aspect of this Art and Science of Trading course is a lifetime association with a group of active traders. So what I've done over the years, I've maintained a group of participants from National Stock Exchange and IBM and the other corporates where I've trained. They're part of an elite group that I maintain. We share market views, news, we share book reviews, software reviews, etc. Essentially a group of guys who are like-minded and they want to share their views and news about the stock market. So each and every participant who joins this course will be a part of this group. And in this group, you can ask any questions or interact with me or any of our participants for as long as we live. A little brief about the theory, what we are looking at. So these are essentially the part that we will be covering. We'll be talking about a bit about technical analysis. What is price? Price is God's most important thing. Volume and open interest. Open interest, a factor about the futures market. And these things are important, and we'll be talking about them, and these are the basics, the foundation of our theory. We'll definitely talk about Dow theory, though we will not be per se using Dow theory as a whole, but Dow theory as a theory gives a very good structure to the market, very good structure to the charts that you will be trading. So we'll use Dow theory and know more about that. We'll be looking a bit into the classical chart patterns also. Not each and every one, but as I said, the ones that are tradable, the ones that makes the maximum sense. If you ask me, one would be something like a symmetric triangle, where the market trades within a triangle and breaks out either on the upside or on the downside. My personal experience trading these triangles have been very well. So I'll be sharing how to trade these symmetrical triangles. We'll be talking about candlestick patterns also, but we'll be adding an extra one, which is the Heikin-Ashi. In the next few slides, I'll show you how an Heikin-Ashi candlestick actually chart looks like and how one can use it quite effectively. Indicators and oscillators. Yes, this is one part. As I said, there are zillions of them and one can actually get lost. Over here, we'll cut down. We will categorize our indicators. First, we will know what is an indicator. We will categorize it just to know which indicator fits into which category, and then use only those ones which are useful for us. We will use a trend indicator, we'll use a momentum indicator, very few ones which gives us information about taking our trading decisions. Fibonacci, the art part. Fibonacci is a tool which one uses to find out upside downside targets, a bit of support and resistance also. This is a vastly subjective field and this needs a lot of training. I will be showing you hands-on how to use Fibonacci retracement, how to use Fibonacci projection, and the other one, the third one, which is Fibonacci extension. The retracement is used to find out support and resistance. The projection and extension are mainly used to find out upside and downside targets of the market. This is a subjective part of our theory, and I would recommend all our participants in Art and Science of Trading to continue practicing the Fib tools. We're talking about different philosophies of trading. Now, this is from where we will branch out to set up our trading strategies. We will learn to build up swing trading strategies. We will learn what is trend following strategies and how to build them in your software. The other one, which is the brave hearts try to do that, is contrarian. Trend following is a type of straight trading where you wait for a trend to evolve and you try to follow the trend till it lasts, makes the most out of it. In swing trading, what you do is you find out a trend which is already there, up or down, and you try to make the maximum out of each and every swing in that trend. That is swing trading. Contrarian trading is a completely different ball game. A contrarian trading is where you're trying to pick up the top and anticipate a fall, or vice versa. You're trying to find out a bottom and anticipate a contrarian move on the upside or on the downside. Swing essentially falls under the domain of trend following. Contrarian is a completely different beast altogether. After this point, after we've gone through the relevant theoretical part, we will be talking about these philosophies of trading, and we will be setting up trading strategies. These trading strategies will be a function of the indicators and oscillators and the patterns and the theory that we will learn in the first half of this course. We will be doing a bit of intermarket analysis also. I found this quite useful in my days when I trade. By intermarket analysis, I mean how the different markets are interconnected. How the commodity market is connected to the equity market, how the equity market is connected to the forex market, and how the forex market is connected to the rate of interest market or the bonds market. So we will not get very deep into it because that in itself will become a course, but we will be looking into those basic ones which every trader, especially in the Indian markets, should keep a watch on. The most important part will be keeping an eye on the dollar and what dollar does to the commodities. Dollar, be it the USD INR pair or the dollar index. So again, under intermarket analysis, we'll keep it relevant to the point and only cover those things which will help in our day-to-day trading decision making. Now we come to the core of it, the art part and the psychological part. Money management techniques. This is essentially a lot of work in our Excel sheet. We'll be setting up rules wherein we will decide how much to buy. Till this point, setup of trading strats, we will be using our whatever we learn in the course to pick up a stock, to go long or short on a stock. This part comes is once you've decided which stock you've picked up, the money management techniques will decide on how many, what is the quantity you're going to buy. So that is called bet sizing. It's very important. And if you ask me, if you're a great stock picker but you don't have good money management techniques, you're not going to make money. If you have great money management techniques but you're a lousy stock picker, there are high chances you can probably still end up making some money. And I'm honestly saying that because we at our end also had done a little study where a random system wherein the buys and sells are completely randomly developed actually leads to some money if it comes with good money management. Then the last part, psychology of traders. This is a very important thing. There will be a lot of things that we'll be focusing on. One-on-one interaction of each participant with me, trying to understand from where they're coming, trying to understand their psychology of money, of how they can handle risk, stress goes into this part. We'll be looking to have some games, some case studies, some video case studies, which will help them to understand what is the right psychology of a trader and what's the wrong psychology of a trader. So Heiken-Ashi and setting up of trading strategies. In this webinar, I just thought of giving you a little brief of what these two things are. So let's see, Heiken-Ashi candlesticks. On my left, I have the NSE Nifty chart, the candlesticks charts, and the candlesticks that we know of. And this is an Heiken-Ashi candlestick. By just looking at it, you can find out that when there's a nice trend, be it uptrend or a downtrend, this is how the candles will look like. But if you notice the Heiken-Ashi candlesticks, they tend to be much more smoother. In this case, most of these candles are blue in color and you're not too worried by the day-to-day volatility of price. Same thing if you see when the market falls, in between, in the candlesticks, you may have a couple of more of them positive moves on the other side. On the other hand, if you look into a Heiken-Ashi chart, it's just smooth and it falls. So this helps a lot. A Heiken-Ashi candlestick from a trading point of view does help to stay with the trend. There are pros and cons to using an Heiken-Ashi candlestick as well. In this course, we'll be talking a bit about candlesticks and a lot about Heiken-Ashi candlesticks and how one can use them. Heiken-Ashi is essentially an offshoot of the Japanese candlesticks. It's just the way that it is calculated. So what it does, it takes the open and close data from the prior period and the OHLC, that is the open, high, low, close data of the current period, is to, graphically represent. It's like a combo candlestick. It has the same data that a candlestick has, OHLC, same thing. But what it does, it considers the open and close of the previous candlestick, and it comes out with a combo candlestick, which helps to, cut down the volatility a bit. It's a Japanese word, and Heiken essentially means average, and Ashi means a pace. So what we are looking to do, what a Heiken Ashi candlestick does, is essentially averages out the pace at which the prices are moving up or down. So it gives a much more smoother, clearer, cleaner picture to the underlying trend. They are not used as normal candlesticks. We will be focusing on normal candlesticks where there are various kind of patterns like a hammer or a hanging man, etc. Heiken Ashi candlesticks are not used like that. They're used mainly predominantly from the point of view of trading, how to set up your stop loss, what are the chances that the trend will reverse, etc. In this course, we'll be looking in detail into Heiken Ashi candles as well. These candlesticks can be used to identify trending periods and potential reversal points. Let me show you how. Lack of wicks. So when a chart or when a stock is in a nice trending move, let's say for example in this case the trend is moving up, or in this case when the trend is on the downside, you will notice that each and every candlestick, most of these candlesticks, 99% of them, will not have wick on the downside. So if it's an uptrend, there will be no wicks or shadows in the candlesticks. Those who are new to candlesticks, let me just briefly tell you, a candlestick looks like this. This is the body of the candlestick, and these are the wicks or the shadows. This is the upper shadow, this is the lower shadow, and this part is called the body of the candlestick. Now you'll see in Heiken Ashi candlestick, the way it gets calculated, if there's a strong underlying current on the upside, each and every candlestick may have an upper wick, but it will not have a lower shadow or a lower wick. As long as you have a candle like that, you need not be too much worried about the trend. It will continue to go up, and it will not have the size of the body may differ, but there will be no lower shadows or lower wicks. That's a sign of a very strong uptrend. The opposite side of it is when there is a strong downtrend, there will be no upper shadow or upper wick. It can be a very long candle, it can be a very short candle, but if the underlying current, if the underlying trend is very strong, you will notice none of these candles have any upper wicks. So that's a sign of a strong downtrend. That's a sign of a strong uptrend. So lack of wicks, whenever you spot of that in any uptrend or downtrend, you know that we are in a strong trend, makes sense to ride the max out of it. The other part of Heiken Ashi candles are the dojis. Again, just for the sake of those who are new to candlesticks, a doji candlestick is one which has long upper shadows and lower shadows, but a very small or none of a body, very less body. So you will notice that every time a trend reverses from up to down or down to up, there will be high possibility of dojis shaping up. There will be high possibility of dojis taking a shape before a trend reverses, right at the top or before. N number of times you will find such examples. So if I'm trading this chart, if I've been long into Nifty all this while, I will be fairly comfortable and hold on to my long trades until and unless I find some kind of shadows creeping up over here. The moment shadows creep up both on the up and the downside, it gives a signal that the underlying trend, which has been up for a very long time, is actually slowing down. So what I can do, I can trail my stop losses, or I can take some partial profits. You see over here we have another doji where we have an upper shadow and lower shadow. We can trail our stop losses over here, so we get a nice exit, or we can continue to take some profits out of the market. If you have not got into this trade and you've been just waiting on the sidelines, and you find after a series of candles with strong uptrend, you find candles which are these kind of nature, doji in nature, the possibility is that this trend can reverse. So you don't buy into this. You stay away from these kind of candles. Same thing happens on the downside. We have a strong downtrend. We have an emergence of a doji or shadows on both the sides. What do? You trail your stop loss aggressively on the downside. So these are two important aspects about the Heiken Ashi candlesticks. The lack of wicks as well as the doji. The lack of wicks means that we are in a nice uptrend or a downtrend. That is, we are in a nice strong trend and you ride the trend. The existence of dojis generally come at the end of a strong trend, so that gives you an early signal that the trend probably is easing off. Moving on with the theory part, I just thought I'll share with you a bit about a very widely used indicator and a widely misused also indicator, which is the stochastics. There are various parameters of stochastics that you can use. I would generally suggest that you use a combination of 1433 or something like a 1483. I'd request to just mute yourselves. There's some background noise. This will help every one of us to participate in this webinar. If you have any doubts, any questions during the webinar, please drop in your query at the end chat window, and I will take each and every doubt as on when I look to conclude the webinar. Each and every questions will be answered, so don't hesitate to ask questions, please. Requesting you again to keep your mics all muted so that there is no background noise and every one of us can hear me clean and clear. Right. I think everything's fine now. Okay, I have a small question from Abhijit. He wants to know the range shift method in the RSI indicator and 5-star method. So this is one technical question on a particular indicator, which is the relative strength index. And RSI complete handbook is something that he has read and all. So I'll take his question. But RSI per se is a momentum indicator, and the divergences in RSI are a very strong thing. I'll show you the divergences in stochastics. RSI divergence, Paramjit, are also similar in nature. Pravath has asked me, is Heiken Ashi applicable to intraday trading? Yes, these are all theory that are applicable to all time frames. It's just that you have to decide what time frame you want to trade. If you're trading the 15 minutes bars or the 5 minutes bars, you can use the Heiken Ashi in those time frame as well. There won't be any issue. Right. Going back to stochastics, this is one indicator, as I said, is widely used and widely misused also. I will show you a couple of things, and in the next slides I'll be showing you stochastic divergence also. In that case, I will to a lot of extent answer your question on RSI positive and negative divergences. Well, stochastics, as I said, the parameters that one can use is 1433, 1483 also works well. You can use 1453 also. I'm using over here in the Spider software 1433. What we are looking at into stochastics are, as we all know, or if you're not too much aware of, it's a momentum indicator which takes a certain period of times highs and lows range and finds out. So when prices fall, stochastics generally fall to the oversold range, and when prices go up, stochastics itself also goes up in the overbought range. Manish is asking a question, what do they mean, stochastics? So Manish, hear me out. As I said, stochastics is essentially a momentum indicator, and it calculates the momentum of the price move. Momentum indicator is the most widely used. By 1433, I mean when you plot stochastic indicator in any of the software, it will ask for days to select. So 14 bars, it takes a range of 14 bars and does a calculation. It comes out with a part called percentage K, right? Sorry for that. It calculates and it finds out a concept called percentage K. Then it takes an average of that, that is a 3 period, then it does the same thing on a 3 period. We'll be doing very detailed calculation and understanding of such momentum indicators in our entire course. Within the limited period of this webinar where I'm talking about a sneak peek of this entire art and science of trade trading course, I'll limit on how to use one. So Manish, let's see how to use a stochastic quite effectively. So what essentially stochastic does is, it calculates the momentum of price moves. When prices are moving up, it tends to move up as well and stay at the overbought zone. When prices comes down and moves into a downtrend, they tend to come into the oversold zone. Having said that, the way to look into a stochastics is one very important, is the divergence. So I guess you hang on, and the person who asked me a question on RSI divergence, positive and negative, Paramjit, just hear me out, because divergences for momentum indicators like RSI and stochastics are more or less the same. Now divergences are essentially two types of case. There is the positive divergence, a positive divergence, and a negative divergence. Okay. So what is let's say a positive divergence? Now look into this screen. Over here you see that this small part of the prices, the market have been coming off, have been coming down, and the markets have been making lower lows. Each and every low is lower than the previous low. This is one part that we'll be covering in our theory when we talk about Dow theory. You see that the stochastic indicator also matches this, but the fact that it starts to even out, it slowly starts to even out. When it's still lower, this thing is not lower, it's flattening, it's same. This is an example of a positive divergence. A positive divergence generally leads to a reversal on the upside. There's a little bit of background noise. I'll request the new attendee to please mute yourself. It will help us to conduct this webinar effectively. Eva, please, I'm requesting you to mute yourself. All right. Thank you. So going back to stochastics, this is what a positive divergence is. A positive divergence is something where the prices continue to make a lower low. In this case, we have the prices making a lower low, but the indicator is not making a lower low. On the other hand, it starts to make a higher low. This leads to a move on the upside. This is a positive divergence. A negative divergence, on the other hand, would be something like, before moving into hidden divergences, a negative divergences would be something like where the prices continue to make a higher high, but stochastics don't make a higher high. Let's say we have the prices moving up like this, and the price is making a higher high. Every time price is making a higher high. If you plot the stochastics itself will match it. But if you have a stage where prices makes a higher high, but stochastics, this is the stochastics, this is price. But the stochastics fails to make a higher high. On the other hand, it makes a lower high. A sequence of this where the price is diverging from the stochastic, or the stochastic is not matching the price, is called a negative divergence. Once I'm done with stochastics, I'll open my software on Spider or any of the ones I use, and I will go through random stocks and find out if there are divergences on the stochastics or the RSI indicator, be it both positive or negative divergence. Few things that I would like to show you. There's something called a hidden divergence. Right? Now, what does a pure divergence do? If you have followed me so far, a pure divergence, which I showed you in my last slide, essentially what it tries to do is it tries to find out that zone where the trend is reversing, right? Where the trend reversal happens. If there's a downtrend and there is a positive divergence, then the possibility high that it will move up. If it's an uptrend and there is a negative divergence, then the possibility that the market will now fall. That's fine. That is the area of pure divergence, be it in stochastics or the relative strength index, that is the RSI. There's the other concept of hidden divergence, how to use them. The hidden divergence is used if you are in a strong trend and you want to participate in that strong trend. Okay. Now let's say this is the chart of Nifty, and throughout this high to this low, the market have been coming off, and you have not managed to go short into the stock, but you're waiting for the right sweet spot to short. So when should you do that? Hidden divergence will help you, and majority of the time, 99% of the time, they go right. So you point this, you find out that the market made a high at this point of time. The stochastic indicator was over here. Fine. So the market fell and bounced back. It came to this high. What did the stochastic do? The stochastic also followed price. It fell and it moved into another high. You see, price is lower. The highs are lower. So in this case also the high is lower. That's fine. Prices continue to fall over here, makes a high in this zone. Stochastic also falls and bounces back. It makes a high. This is still lower. This is also still lower. That's also fine. Now is the zone. Now you see prices makes another lower low, lower high. This is a lower high, this one. But look very closely. Stochastic has made a higher high. Bang. This is the zone where the market screams at you. It tells you that we are in a downtrend. Market is continuing making a lower high. Lower high means weakness. But the momentum in that last one has gone up. It's a higher high. This is the zone where one should look to short. This is a hidden divergence. A hidden divergence, unlike a pure divergence which reverses the underlying trend, it helps you to do a swing trend. When we conduct our art and science of trading, and we will be talking into those classes of setting up trading strategies, we'll be using divergence and hidden divergence quite extensively. When we set up our swing trading strategies, we will implement hidden divergence from stochastics or RSI to find out those zones where the risk reward is highly in your favor to carry on a trade with the underlying trend. In this case, the trend was down. This is the area where you look to go short and probably try to make the maximum out of these kind of moves. Hidden divergence are both positive and negative in nature, so we'll look into those also when we look into these charts. This will help us to find out pretty good trades from the point of view of risk reward. Okay, now a few practical things. As of now, I've just spoken about just a very few things that we'll be covering in our course of art and science of trading. We've spoken about the Fibonacci candlesticks very briefly. We've just briefly shown you what is the stochastic indicator and how effectively you can use. As I said, I'll repeat myself. With art and science of trading, we will not be going into the history of each and every indicator. We'll be telling you what the indicator is, what are the pros and cons of the indicator, how it is calculated, and how one should use it effectively. If it does not suit you, you might as well not use it, rather than continue to use indicators which does not give you any usefulness. When we go into our practical sessions, we will be using softwares. Spider Software and InvestorIndia.com are our software partners. So those who will be interested will get these softwares for a demo period. You can use it for our practical classes. So for art and science of trading, these are essentially weekend classes, and we'll be meeting every Saturday and Sunday for 6 hours and talking about the theoretical part. And during the remaining weekdays, there's an internship part of this entire course. You can, if you are in Calcutta or decide to stay in those 6 weeks in Calcutta, the weekdays, there'll be practical sessions where we'll be tracking live markets, especially the forex market through netdania.com, and we'll have internships, interns. And this will be around 3 days a week for like 4 to 6 hours. My team will be there, and we'll be doing this internships on netdania.com also. So weekends and weekdays as well. Those who would like to participate from outside Calcutta definitely will have some kind of an online arrangement where you can look into these classes live as well. So moving into some practical, let me show you. Well, this is the Iris software, the Spider software, and we have the NSE Nifty chart. As I said, let's open some random stocks and look. Let's try and look few of the stuff that we've learned. Let's say I open the chart of Tata Steel. Okay, now you see that Tata Steel is in a severe downtrend for quite some time. And if you've been using Heiken-Ashi, what I said that in Heiken-Ashi, these are the places where you don't see any upper wicks are the strong downtrends. The moment you try, you tend to see, wicks on the up or the downside. That is when you trail your stop losses. Stop loss trading is also an art by itself. So we should, we'll be doing that in detail in our art and science. We'll be talking about underlying volatility. Let's plot an indicator. We have what? We have done stochastics. So let's say 1433 is the period that we chose. And let me add this. Also for Paramjit, who had asked me a question on relative strength index, let me plot the relative strength index and let's take the time frame down a bit. Let's say 8. Relative strength index, and let's have both my indicators. So in this case, you will see that whether you have any kind of positive divergence or negative divergence with the stochastic indicator or not. Before that, if I tell you that there is a nice little hidden divergence on the stochastics, you see that this is the strong trend that the entire stock was into. So this was the high, this was the stochastics. Follow this one. This is the part. The stock continues to go down, stochastic goes down. Now you see in this zone, this is the area where prices went down, made a lower high, but you see over here, the stochastic has made a higher high, right? So this is the zone. This is the candle 1, 2, 3. This is when the stock is screaming out and saying that this is the zone where the possibility of a short trade, going right is much higher than that of a contrarian long trade. This is the kind of shots that one should take. If you try to go short over here, you are more of a contrarian. If you're going short over here, you are a swing trader. Understanding this, what kind of trade that you're looking for, understanding this, that what kind of a trader you want to become is the psychological aspect of trading. That is something that we will be, focusing on very closely, very key. This is very important. Don't try to pick up each and every highs. No, but if you can pick up these kind of highs quite regularly in most of the stocks, that is where the most of the alpha returns will be made. It took me a lot of time also to realize this. All these things have come after years of trading, both successfully as well as having patches of unsuccessful months. So this is what a hidden divergence essentially is. If I can change the stock and let's say I go to something like let's say Reliance Industries. Right, now you see in Reliance Industries we have a strong positive divergence. See, the stock falls, it makes a lower low. Over here you see the stochastic values. The value of the stochastic has gone up. This is a pure divergence which helps you to tell you that, okay, the possibility of over here a trend reversal is high. That's the difference between a pure divergence and a hidden divergence. A hidden divergence will help you to do a swing trade. A pure divergence will help you to do a contrarian trade. Right? Let's see over here. So this is a strong uptrend that Reliance Industries was from March 2014 all the way to like May. And you see that it continued to make a higher high, and so the stochastics was following it. Now you see the stochastics was over here. This part of the low, the stochastics is somewhere over here, high up there in the 77 zone. Then it had one fall, but you see how far the stochastic fell. So this is an uptrend. This is an uptrend. Prices makes a higher low. This low is much higher than this low. But look at this low of stochastic. Is significantly lower than this low. This is where a hidden divergence lies. And this is the place where you do a swing trade. This is where the chart screams at you and says that, dude, this is the place where making a low risk long trade makes much more sense. And this is what pans out. So as I said, if you're trying to buy into this, you're a contrarian trader. But if you're buying this, you're a swing guy. We have to find out what suits us. For that, we will be going through the psychology aspects of the course in Art and Science of Trading. I'll share with you another software. This is NetDania. Alright, Pranjit has asked me a question. I want to ask about frequently changing values of RSI. 30 to 70, 70 to 30, and what do you select in this range? Okay, Pranjit, good question. To answer Pranjit's question, he's asking what should be the overbought, oversold parameters of relative strength index. Okay, now what I'll do is, just to answer his question right, I'll remove stochastic. Now when we plot indicators in any softwares, it will ask you overbought, oversold. You see 70 and 30 are the by default. 70 is overbought and 30 is oversold. What does it mean? If RSI goes above the level 70, the prices are overbought and it can come off. And on the downside, if it falls below 30, it's oversold. Now 70 and 30 are the by default levels, and these were the levels set by the developer of RSI, Mr. Wallace Wilder, and Mr. Wallace Wilder also suggested the time period of 14, so 14 and 70 and 30. But if you ask me, having a range of RSI overbought, oversold makes much more sense. So what I have used in majority of my years, I've used 70-80 on the upside and 20-30 on the downside. So if I modify this, you will see now on my chart, this is the RSI at the bottom, and I have a range, these two dotted lines. This is the range on the upside. So every time RSI goes into this range, this is signaling me the possibility of a top is there, or the prices can ease off. Similarly, on the downside, you see over here, RSI falls below the 30, stays below 30, but above 20. This is the range where it's kind of oversold, and prices may bounce back. Just to add another small thing, Paramjit, it's very clear over here if you see that there is a positive divergence with the RSI and price. So price continues to fall, RSI goes up, this is the range shift that is happening in RSI, and bang, the market reverses on the upside. We'll be doing a lot of these examples in our course, the Art and Science of Trading, in details with RSI as well as the stochastic indicator. I hope I've managed to answer your question, Paramjit. Moving on to our practical aspects, this is the net station of the netdania.com. This is the software that we will be using. This is how the software looks at my end. I have the NSE markets, the NSE indices, Nifty 50, the FX which are traded there, the commodity in the Indian markets also. And let's say this is the USD INR chart. And this is a fairly good software when it comes to tracking the markets. It gives real time with a little lag of like 5 minutes for Indian markets. You can track the global markets also. The idea of having multiple softwares is to have our focus open on not only just on Indian markets, but to track and understand how the other markets work out. So this is global equity. I have Dow Jones, FTSE, DAX, Euronext, CAC, Nikkei. So one can actually track the Dow, and that's why I have included the usage of NetDania in our course, so that you actually learn or have hands-on training in a little variety of softwares. So you can play around, you can change the time frame from daily to weekly, and then later on move back to any of these time frames. Starting from 1 minute goes on as much as the monthly charts. InvestorIndia.com is another software partners of ours. This is their website. We've been seeing their software is fairly good. You get some fundamental data on the Indian stocks and Indian markets also. So our intention with the Art and Science of Trading is to give you hands-on training on these softwares as well, and not just cloud you with all the theories that is there in trading. Moving ahead. The concluding part of our course, I'll be focusing more on the psychology part, and I'll be conducting this entire course A to Z, where towards the end, this is where I sit and discuss with you the psychological aspect of you as a person, not getting too much into personal details, but to understand you as a person, and how you can develop your mind so that you can start thinking like a trader. Everyone who comes to the market wants to make money. There's no one in the market who comes to the market and says that I'm here to lose money. But only 5 to 8% or at max 5 to 10% manages to make money. So what goes wrong? And I'll repeat, I'll say that honestly, I had my patches of bad months also where I was completely demotivated. And I thought that this is not for me and I'm not a born trader, etc. It's nothing like that. It's all about this part, the psychology part. So for the success of you being a successful trader, you have to understand what is risk, right? You have to understand it. What is risk for you? What is risk for you may be completely different for what is risk for, has been risk for you, for your father or for your wife or for your son. What is risk for you? What do you mean by risk? What do you bring into the table when you're into the market, when you want to trade and try to make some money out of the market? What do you bring into the market? How much are you willing to risk? And by how much, I don't mean what great money you want to risk. Is it a 1 lakh or 100 million or stuff like that? No. It's a function of your psychology. The other part is stress. How do you control it? Because if you're in this game of trading, it's not going to be a smooth ride every time. It's going to be a hell of a ride, a roller coaster. And that's going to give you some nice dose of, cortisols in your brain, which will lead to those stress hormones. So how do you manage a good lifestyle? How do you, by lifestyle, I don't mean having a fancy lifestyle. I mean that a stress-free lifestyle. Because if you trade, you don't bring in your personal problems into the table when you're trading. That's going to lead to a lot of problems. That's going to lead to a lot of stress. So we will learn how to control it. There'll be practical games. There'll be practical exercises where we would talk about stress and how to reduce it. It's very important. Attitude, another thing that we need to control. Okay, because when the going goes right, people tend to feel like I'm the king of the world, and each and every trade of mine goes right. And exactly that's where the trend reversal is. You don't do like that. You need to maintain a very a lot of gratitude to the market, because the market knows everything, and whatever, if the market is being kind to you, you will get those returns. You just have to stick to your discipline. So keep a check on your attitude. You will have rounds of very successful weeks and months. Okay, fine. And then you will definitely have a sequence of weeks and months where you will have negative drawdown. Okay, you'll have positive. The markets will reward you. The market will also take money from you. It's the part of the parcel of the game. Both the aspects will happen. It's just like a coin. You cannot have just one side. How to deal with them and how to develop discipline. So essentially, what I've been trying for quite some time, I have not reached it yet, is a stage where if you've made money, whatever is your facial or emotional state at that point of time, and even if you've lost that same amount of money, you should have the same feeling or the same expression. It's easier said than done. As I said, I'm still working at it, but I can see it. It's possible. And as I said, my experience with talking to a lot of experienced and successful traders has been like that. End of the day, you talk to them, you don't know whether have a great day or a bad day. So that's how we develop. We hone our psychological aspects to become like a trader. In the psychology part, we will be, as I said, learning a few things, how we can avoid few trading biases. Trading biases, it kills you. Very important how to avoid them. Initiate low risk trading ideas. Let's not run for each and every breakout in the market. No, patiently wait, quietly wait for your setup, what you have set up, for your setup to shape up, and only trade your setup, not your neighbor's setup, what the newspaper or the news channel is saying. No, let the world do anything that it wishes to do. It can reverse in an hour, but you wait for your strategies to develop patiently and those low risk trading ideas. We'll have a systematic approach. All these things will not happen in a day. That's why I have kept the community thing at the end of my course. The fact is, once you learn the theory, once you have the hands-on practice, the practicals, you go to the market, you will feel your ups and downs. That's why you stick to the community, you come back with your doubts, you come back with your questions, and you try to reach that stage where you are a trader yourself. So you should have a systematic approach. And to keep you in a systematic, disciplined manner, that is where the community comes in. Trend is your friend. Ride your winners and cut your losses short. This is something that you probably have heard and read a million times in all the books. Easier, the one sentence which is easier said than done, as I said. But honestly, this is what makes a successful trader. How to ride your winners is a psychological game. It is contrarian to your behavior. And how to cut your losses short is again against your behavior. So both these aspects are essentially designed against nature. So we have to understand this, and we have to start systematically applying it. The moment you start to do that, you will see that the returns have started to come in. Position sizing is bet sizing, is what we talk about money management. This is also a very important thing, because this guy, bet sizing, is the one that will keep you stress-free. If you do it properly, this is where your stress will be on the downside. So we will learn many ways in which you can do position sizing and or bet sizing. Okay, this is an experiment that I'm trying to do. I have a small little video over here. This is a $1 Million Trader, a documentary. So what I'm trying to do over here with this webinar is I'm going to play this. If you can hear the audio, you just listen to this documentary for the first 5 minutes. If you can't hear it, if you can't hear the audio of this documentary, then please use the chat window to tell me if you can hear it or not. Okay, I got it. So you can hear me now? Yes, okay. There's a little bit of background noise. I'll request please to check your mics and mute yourself. As I said, the organizer anyways will mute you. Yeah. Okay, what I was trying to do over here was I was just trying to show you a small little video case study which is a part of our art and science of trading. Out of many documentaries and movies that we will be showing to during our internship days in art and science of trading, this is one of them, which will be a part of the psychology class, where we'll be showing you a documentary, a part of it, the important part of the whole thing, and we'll do a case study. This is $1 Million Traders, a BBC documentary which is there. You can see it yourself, but what I see and the kind of questions and case study that I have designed will help you give an edge, have a shortcut to understand how a successful trader trades, feels when he is right in front of the screen, how an unsuccessful trader sweats when he sees the trade going against it. If you see the video tonight, you will see it just like a documentary or a movie. But when you see the same video after we have done through all our courses and all the theory and practical class, you will get the picture, which you will probably not see it now. You'll get the picture that, okay, now this is what trading feels like or may feel like when I am in his or her shoes trading in the market. So that's more or less about it today morning. The intention, the objective was to share with you a little sneak peek about the art and science of trading. This is a 36-hour session where we talk about theory, practical and case studies. The first batch starts on the 21st of Feb. We'll be talking about technical analysis, trading, strategies, setups, intermarket. And this webinar, my intention was to show you a little bit of sneak peek. Guys, if you have any questions, please feel free to ask me. be it a question on the course or any other questions related to trading or technical analysis. I'll be very happy to answer your doubts and your questions. Also, we have a feedback form for this webinar. Prakash is asking for the charges. Prakash, I will request you to get in touch with us, and I think there'll be Kiran, Swati, anyone who will help you with the charges and the details of the course. Mehul, the course will start 21st of February this year. It is viable for big beginners, yes. I think it's a big plus point for the big beginners compared to the ones who are already in the market. Because if you are a big beginner, your slate is clean and you will be learning only the relevant aspect of the market. Okay, if someone has 10 years of experience and still not making money, means that whatever he or she has learned has not worked. So a lot of unlearning goes into it. So a big advantage if you're a big beginner, because from the first course only you would learn and get a hands-on training on the relevant ones, not the irrelevant ones. Where will the classes be held? We'll have two different versions, couple of different versions of the class. Yes, the classes will be held in Pretoria or Sector 5. Predominantly it will be in Sector 5, but as I said, it will be we'll try to keep it a small batch, and it will be a mix of both Pretoria and Sector 5. The weekdays where we conduct the internship, where you have hands-on training on live softwares, that will happen in Pretoria. And the weekend classes will be a mix of both Sector 5 and Pretoria. These classes will be in the city of Calcutta, but we will be implementing an online version where we'll keep you updated, where if you're not in Calcutta, but you can attend the theoretical classes online. But we'll request you to come the last week to Calcutta and attend for the psychology classes. Because in those psychology classes, there will be one-to-one interaction with me, where you spend face-to-face with me and talk about trading and what you've learned and unlearned. So even if you can't make it to Calcutta for the classes, what I'll request is you attend it online live, but do come in the last week to interact with me and share all your doubts and questions. Okay, Pravat is asking, I want to follow intraday futures trading. Will it be helpful to me? It will be a lot helpful even if you do intraday or positional. It does not matter. What I'm trying to do with Art and Science of Trading is not only share the theory, not only share the trading strategies that work, but also have the mental metal, the mental makeup of the psychology part. So if you're an intraday trader, you need it the most, because intraday prices move volatile, right? They move up and down quite fast, compared to a positional trader. So if you're an intraday trader, that to the futures market, there are many things that this course will do. The most important thing it will make you psychologically ready to face the market every day. If you had a really bad day, how to be, have the same mental state to approach the market again day after day after day. Okay, how do you contact me? Mehul, you can contact me, one sec. You can go to kredentacademy.com. The course details are there. I'll just key in. Anyways, we will be emailing you. It will be great if everyone leaves your email ID, right? If you can see my screen, I'll just open it here only and I'll show you. Yeah. It will be great if you leave your email IDs. It will help us to reach you after this webinar is over. Okay, when you go to kredentacademy.com, you find Art and Science of Trading. For more details, you can click on it and you will find all the details, whom to contact, etc. about the course. The first batch, the very first batch starts Saturday, 21st of Feb. Right? Also, if you want to reach me, you can reach me on my number. It's 9874847400. Thanks for sharing your email IDs, Pravat and Krishnendu, Mehul. Someone from our end will definitely get in touch with you. Rahul is asking, when RSI and stochastics are in oversold region, and the general trend is bullish, is it a good time to go long? If the general trend is bullish and RSI stochastics are oversold, yes, it generally means that it is a dip in a long-term uptrend and it's a time to go long. But you have to check your other parameters also. You have to check whether the other parameters are confirming an uptrend, a long trend or not. Then only you should take the trade. The fact that the indicators are just oversold is not enough to tell you to buy. It is enough to tell you that in an uptrend you are oversold. It ends there. The information ends there. Okay. Prabhat is asking, what are your prerequisites for conducting outstation training? Prabhat will reach you and we'll talk about this. Right? Prabhat is asking the same question for outstation. So Prabhat, someone from our end will definitely get in touch with you and we can discuss these things. Okay guys, any other question? I'll be very happy to take your questions. If not, then I thank you everyone for joining in. It's been a pleasure from our end. Looking forward for your attendance in the rest of our webinars this month and the month forward also. And looking forward for your participation in this unique course of Art and Science of Trading. Thank you everyone. Thanks a lot. Take care. God bless.